Hello and welcome to another episode of the Mark Moss Show, where we're talking about the decentralized revolution. We're talking about where politics, finance, and technology come together. Of course, it's always technology that changes the world, and that technology is Bitcoin, the decentralized revolution. You know, I like to bring to you some interesting guests. You don't have to listen to me talk all the time, and that's what I have today. I'm joined by Vijay Boyapati. He's the author of The Bullish Case for Bitcoin, and now, previously with Google, now a senior engineer with Swan, a big friend of the show for sure. Anyway, Vijay, thanks for joining me.
Thanks, Mark. It's so good to see you again.
Now, I kind of cut you off before we jumped in here because I was explaining to you how my Twitter account got hacked. So about almost 3 months ago, what happened is I guess now that I've looked into it, they got my email address, put it into like some like spam bot thing or whatever, and all of a sudden my email just started getting flooded with emails, like thousands. It subscribed me to like thousands of like newsletters. And so then I figured they're going to try to hide something. And sure enough, there was like a password reset for Twitter. I was able to get in and reset my password, but they set up a 2FA device, two-second factor authentication. And I've probably filled out 30 requests from on Twitter. And interesting enough, just before I stop, my good friend George Gammon also had the same thing happen to him. And he has an attorney that filed a suit against Twitter because they're still billing us and we can't get access. And they're responding to the suit. They're going back and forth with the attorney, but they just won't reset the stupid 2FA. I mean, it's like the most, just reset the 2FA. Anyway, so you were going to tell me that something that you've done to protect your privacy.
Yeah, it's actually one thing I've noticed is that I've had friends and family who use services where they get billed on sort of regular cadence, and then for whatever reason something happens with that service, they don't like it anymore, or like in your case you got hacked, they continue to get charged, and they don't feel like there's any way they can get out of it because the service has their credit card information and they just continue to bill and there's no way to stop it. I really like and recommend this service called privacy.com, which allows you to create sort of disposable credit cards on the fly, and you connect it to your bank account, and it's kind of this protective layer between your bank account and the merchant that you're using. And so you generate a temporary credit card, and you know when you sign up for a service like Twitter, you put in your temporary credit card number that they give you. And you have full control over how that credit card can be used. You can say the maximum amount that can be charged is $10 per month or per year or per transaction. If you ever don't like the service, you can say, I don't want, you can delete the card. You can set the maximum amount that can be charged down to $1, for instance. And this has been, for me, great protection because our fiat world is broken in so many ways that we need things like this to protect us, because once companies can get our bank account details or our credit card details, they can do huge damage to us. And unfortunately, you're having this experience with a actually well-known and well-established company. It's not a scammer. It's just a well-known company that just happens to not be helping you. And another example of this, my wife signed up for 24-hour fitness, and I'm sure many people in America know about this company.
Of course.
That do this kind of marketing scam to get you on board. And she just couldn't unsubscribe, and they were charging us like $50 a month. So that motivated me to find this service, privacy.com. I'm not affiliated with them, not an investor or anything like that. It's just one of those services I've had such a great experience with. And whenever I hear friends and family tell me about their experiences where they feel like they're getting scammed or they feel like they're getting charged and they can't stop it, I'm like, well, you should try this out. Once you try it out, you won't ever want to go back, because it gives you that level of control where if they have your credit card information, you can really limit the damage they can do to you.
All right. Well, I'm definitely going to check that out for sure. Yeah, I could at least stop my charge. Maybe they'd want me more if they weren't getting my money. We'll have to see. You said that the fiat world is broken in so many ways. I would agree with that. There's probably no end to the amount of conversations we can have and all the ways it was broken. There was a video clip that I saw sort of going viral. Jordan Peterson just had this big ARC conference going on in London, I think it was, this last week. And the guy from Trigonometry, Constantine, I think his name is, had like a talk that went pretty viral. And in the end, he said, hey, and a message to all you conservatives, you're not going to be able to get the youth to vote for your conservative ways, trying to conserve a system that no longer works for them. In a world where they can't afford to buy a house, they can't afford to buy a car, the system is no longer working. How are they going to vote for you? And I thought about that, and I was thinking about maybe doing a video on that, just that it's not I guess it sort of is a political thing, but the reason why it's not working for these people, they can't afford a house or a car, is the fiat money system that's broken. You agree with that?
Yeah, absolutely. And we've seen the culmination of a pure fiat money system that's only really existed for, let's say, about 50 years. I mean, the US was on a gold standard, and some people think the US went off the gold standard in 1933 when Franklin Roosevelt confiscated people's gold from their bank vaults. But really, the US went off the gold standard fully in 1971, I believe it was, when Nixon closed the gold window. So the gold standard still acted as an anchor on the credit expansion that was happening. And once that anchor was completely detached, the credit expansion went crazy. So we've been living this experiment for about 50 years, and I think we're seeing like the full effects now. It really has pervasive impact throughout society. It really increases people's time preference. And in terms of the people who are growing up today and who are moving into the workforce, this is really the first generation in, 200 years, which can confidently say, we're not doing as well as our parents. We're actually doing worse than our parents. That's the first time that's really happened. Every generation prior to us could say confidently, I'm living a better lifestyle than my parents and my grandparents. And that's a really sad statement, I think, about
I hadn't really thought about that, but it makes sense as you say that. So which ways do you think it's a less quality of life?
I mean, people used to, have this expectation that when they left the house, they could get a job and afford a house.
Right.
That's one basic thing. They could afford to have a family. There are a lot of people now who don't believe they can have a family. There are parts of the country where people just don't think it's a possibility for them anymore. Like, you look at the major cities on the West Coast or on the East Coast too. If you're living in one of those places, it's just, if you're living a regular middle class lifestyle, or even if you have a good job, let's say the two engineers at Google, for instance, who are earning good salaries, a lot of people like that, married couples who have two good salaries, can't afford to buy a home in the Bay Area. That's crazy. Now, there's some local factors involved as well. It's not just the fact that we've been dealing with 50 years of uncontrolled credit expansion and inflation. Local factors involved, such as bad policies, that they don't let people build more in the Bay Area. But as a general rule, it's a really strange thing that that people can no longer expect to have a lifestyle better than their parents, given how much technology has improved over time, and given how much we've advanced in so many different aspects of society, that this expectation shouldn't continue into the future. We need to sort of reflect on what is going on, what is broken in our current system that's making this new reality come about.
Yeah, I think when you talk about that, there's other factors such as like building regulations and things like that. But a lot of the problems with building regulations and so forth is also because of the broken fiat money system that we have as well. This overreaching government and misaligned incentives and things like that. The one thing I was thinking though is you were saying how it's sort of changed people's time preference, and that one is a whole topic into itself. But I always think back to Vladimir Lenin. Was quoted saying that the best way to destroy capitalism is to debauch the currency through inflation. And through inflation, you can arbitrarily steal. And then he said, until all relation is lost, until the best way to get rich is through gambling and theft. And today, it sort of seems like that could never be more true, right? I mean, everyone's just out for gambling and theft. It's like YOLO into some whatever options trade or crypto trade or whatever it may be, or like theft. Maybe not in the Bay Area, outright theft, and maybe just a lot of grift and graft going on.
Yeah, I think that's true. We lived through this period recently, which is sort of unprecedented in history, where we had 15 years of negative real interest rates. The Federal Reserve held interest rates at zero, and there was positive inflation during that period. So you're really being punished for saving. If you kept money in cash or dollar denominated assets, you're generally punished for doing that. And so this creates this massive incentive to go out there and go further out on the risk curve and find assets that are almost chasing momentum, essentially, trying to find those assets that are going up just because there's this inflation, and the money that exists has to go and find safety outside of a regular bank account, for instance. So they ran this experiment for 15 years, and we kind of saw the consequences. Inflation started. The inflation genie really got out of the bottle during the pandemic, and they're trying to put it back in the bottle. Mm-hmm. And so now we're actually back to what would be considered fairly normal historically, where you have real interest rates, real positive interest rates. If you are a saver and you put your money in the bank, you will get a real return, which is
not in the bank, but in treasuries.
In treasuries, yeah. Absolutely right. Sorry, you're correct. If you put it in short-term dollar-denominated bond securities, then you're going to get a real rate of return. And this has not been true for most of the last 15 years. This has a beneficial effect in that it encourages people to save, and it changes the way they plan for the future as well. Unfortunately, I think this is going to be a very short-lived experiment. I think the Fed's going to go back to what their default behavior has been for the last better part of the last 2 decades, because the fiat system can't survive like this. It can't survive because fundamentally the US government has this massive amount of debt that needs to be serviced. And with interest rates as high as they are, while that's good for society as a whole, the US government can't continue to function servicing a debt that large, approaching 140% of GDP. So the Federal Reserve, being a part of the US government, will eventually cave in because they will see that the government can't function like this, and the system as a whole can't function. So we're going to go back to negative real interest rates. The reason the Fed is doing what it's doing right now is they need to establish some credibility. They said that they have an inflation target of 2%. They could change their mind and say, actually, we're changing our inflation target. We're going to make it 3% or 5%. But that's what banana republics do. And the Fed really has only one weapon, and that weapon is their credibility. They're able to keep inflation under control because people believe that they will stick to their word, and when they say they're going to bring interest rates down to 2%, they will. I don't think they can, though. I don't think they can sustainably do that because they've let the inflation genie out of the bottle, and they have this huge constraint of, if they really try and kill inflation, they make it so that the US debt is not serviceable anymore. And if they have to choose between these two things, make it so the US government cannot service its debt anymore, which basically implodes the government, or letting the inflation genie out of the bottle, they're going to go with the former. That's what central banks have done for the entire history of central banking. It's just a matter of time.
Yeah, and they have no choice. I mean, to your point, they lose credibility. I would say they've already lost credibility. Maybe most people, for some reason, haven't lost credibility with them. But they told us inflation was transitory, this and that. That obviously would prove to be wrong. But I think there's a couple of big problems that they have. One is that they can only try to basically limit consumer spending. So they can make you and I broke. But unfortunately, at this point now, the government, the fiscal spending is overpowering the consumer spending. So they can only crush us so much. They got to stop the government spending like a drunken sailor. And the U.S. fiscal deficit was $1 trillion last quarter. And now the numbers came out, they're projecting $1.5 trillion for the next 2 quarters.
Yeah, that's the problem. Exactly right. And the U.S. government and the population as a whole is in a really difficult place for fixing this problem. We need fiscal responsibility, but we have such unprecedented polarization in the country. We can't agree to anything. So it's very hard to come together and say things like, hey, can we make a compromise on your side and my side and get this sort of fiscal picture under control? It's just not going to happen. And so I think what we can expect, given the political reality we live in, is that the fiscal picture is going to continue to get worse. The government is going to rack up more and more deficits. At some point, there is a breaking point when the debt is actually not serviceable, when the amount of money that the US is bringing in through tax revenue is not enough to pay interest on the debt. That's when you get the moment of crisis, which is, what do we do? Do we cut spending? Do we raise taxes? That's also politically very infeasible. Or do we go for the last option, which almost all countries go for in the end, which is the easiest option because it's the politically easiest option. Let's just inflate the money supply.
Yeah.
Let's reduce the debt by making it so that the amount of money, the denominator, is much, much greater. And then servicing the debt's no problem because there's all this money sloshing around. That's what's going to happen. And the question is, what is the breaking point for the US government? What percentage of GDP does it become unserviceable? I think
they just got to get the GDP up.
Yeah.
Let's just have a couple years of double, triple digit inflation, and that GDP number goes up, right? So I mean, they can get that number down. I mean that's the most likely scenario. This financial repression playbook, that they ran in the 40s. That Israel ran in the 80s. The IMF put out a white paper in 2015 called Liquidation of Government Debt, which is basically spelling that out. If the debt to GDP is an equation, if we can't get the debt down, let's just get the GDP up.
Yep.
And so it's like, hey, we're selling iPhones for $1,000. If we sell 10 of them, that's 10,000. But if we take the inflation pushes the price to 2,000 and we still sell 10 iPhones, now it's 2,000, right? It's a magic trick. And now I think maybe the last piece that I want to get into is you have this, maybe you said contrarian take as to this Bitcoin bull market. Fed doesn't want to lose credibility. They're trying to regain credibility by getting back to that 2% target, unless they can come up with some good reason, scapegoat, as to why they can't do that, potentially like multiple wars. You kind of shook your head in disgust when I said that. So if you want to address that, you can. But then you had said that you think that maybe this bull market in Bitcoin has already started, which might be controversial for some who think that there's this massive macro picture that's going to crash everything down. So maybe explain that to me.
Yeah, one thing, this prior bull market was really shortened or curtailed. I think, people have put out a lot of reasons, but I think the main reason was that the Fed ended this unprecedented period of 15 years of zero interest rates. And I think when there are positive real interest rates in the market, that's generally bad for competing monetary goods. And the classic example of this is gold. You go back to the 1970s when gold was going through this decade-long bull market and parabolic move in gold, very similar to one of Bitcoin's bull cycles. The graphs actually look very similar. These hype cycles are almost identical. Then Paul Volcker, the central banker at the time, really was determined to get inflation under control and set interest rates close to 20%, I believe, and had very real high positive real interest rates. So you would earn money, you would earn real value by keeping money in the bank. That's generally a period of time which is bad for competing monetary goods. And it was really bad for gold. It was bad for gold for 2 decades. So I think the same thing happened with Bitcoin at the end of the bull market. How long can the Fed go along with this? I think that's an open question. But I think
about to that point real quick though. So if you look at like Bitcoin's history, which isn't super long, so it's not like, super conclusive, I guess. But if you look at like the halving market data, for example, we can see that on every halving, the peak of Bitcoin is 18 months after the halving. So far that's been true. And I, going into this last event after the halving, knowing that it's 18 months, but we had all thought maybe the price of Bitcoin would be, 150,000 or wherever it was going to top out, right? And I have Michael Saylor in the back of my ear going, all your cycles are broken, and you see the big institutional adoption coming in, and so maybe it would be higher. And so then as we get to this November date, this 18 months after the halving cycle, I remember thinking, this can't be it. No, this cycle is going to be broken at this point because the price should be so much higher. And right on cue, right at 18 months after the halving cycle is when the price dropped. And yes, it was with the Fed's announcement that they were going to start, raising rates. Now, they didn't actually raise rates until they announced it in November. They didn't actually raise them, I think, until January after. But just the announcement was enough to move the market. But anyway, is that just coincidence? Do you think that it just happened to be right at the 18-month mark, or was it, or is it more of the halving cycle?
Yeah, I had the conversation about this with Stefan Livera on his podcast as well. I think there are two factors at play. There's the internal Bitcoin market dynamic, and I actually believe the halving is a real driver of price movement. I think the halving will be again, because the market in the bear market has to find a plateau where there's an equilibrium between supply and demand, and we've had that equilibrium essentially for the last several months. But then the halving comes along, and it really is this huge supply shock where the supply is halved. So the amount of fiat money that needs to come into the Bitcoin market to maintain the current price is something like, I don't know, $40 million a day. And then suddenly you only need half of that. But the demand, the people who are buying Bitcoin, that demand doesn't halve. It's still that same level. And that supply shock makes demand above supply, and it starts moving the price up. And then it starts feeding on itself, and then you get the madness of crowds phenomena. So I think there's that internal market dynamic. But I think Bitcoin now is big enough that it's a macro asset, and it is affected by macro factors like interest rates. So I think both of those things are at play. I would probably say the 180 days is a coincidence. My strong belief is that it was really interest rate led. I think the Fed hurt all risk assets, all interest rate sensitive assets, and I think Bitcoin is an interest rate sensitive asset. But Bitcoin also has this internal market dynamic, which you're talking about, which is the 4-year halving cycle, and I think that's still very powerful, and I think it's going to trigger the next bull market. But for me, it's not just the fact that we're approaching the halving, it's just looking at the price action of Bitcoin. That price action tells a story, and it's telling a story that bad news is not hurting Bitcoin. In a bear market, good news does not help. In a bull market, bad news does not hurt. And so when you see that price action, you know we're entering a bull market. And there's been, plenty of news that would normally knock Bitcoin down, but the price keeps going up higher and higher and higher. Then there's other factors as well that could be propelling it, including the potential approval of an ETF, which I think will be a good market catalyst. But it's undeniable. You look at the price action of Bitcoin right now, it looks like it's ready for a big bull run.
Yeah. One chart that I've been amazed by, you mentioned real rates earlier, and you can look at charts with inverted real rates, and it's like lockstep with gold. I mean, since the last couple of decades, gold and real rates have just moved almost in lockstep, and now there's this massive divergent. So there's something going on there that tells us something, right? And then you look at other factors like this narrative shift, if you will. Larry Fink, the largest asset manager in the world from BlackRock, came out and said people are running to Bitcoin for safety. Like, to hear him come out and say that, and so I think that's why gold is diverging, right? I think people are starting to realize, and maybe not in the United States, but the rest of the world is like, we don't want U.S. Treasuries, so we can see central banks are net sellers of Treasuries and net buyers of gold, and so it's causing this divergence. But I think it's also Bitcoin and gold sort of moving in that way. Just to kind of go back, so back to the halving cycle, if the Fed would have announced they were going to raise rates a month later, then this whole 18 months after the halving would have been broken. That'd have been your base case.
Yeah, I honestly believe if the Fed had maintained zero interest rates, say a year longer, we would have probably hit 100,000. That's my belief.
Yeah. Yeah. All right. So do you think it did maintain its halving cycle kind of structure? Do you think we're back into this halving cycle structure again now? So now we're about a year and a half before that, or?
I think so, and it's really remarkable. You look at these price charts for each cycle and you overlay them, and they're eerily similar in terms of timing from halving. Just as you use the halving as the anchor point. And Satoshi did something incredible, like choosing this system where we had a 4 year halving. You could almost imagine that this 4 year halving, if it had been some other number, it might not have had the same impact. It's almost like 4 years is enough for the pain to be forgotten of the previous cycle and
Yeah.
the enthusiasm to rebuild. You need it's he almost tapped into some human psychology here to know what the ideal time was for creating these supply shocks. If they had been every 6 months or so, I think it wouldn't have had the same impact as it does.
Yeah, it's a good point. I didn't really think about it like that, but typically I started my career in real estate investing, and typically the old adage was, don't buy a home unless you plan to hold it for at least 5 years. So you have sort of like these 5 year, you have these longer, maybe 8 year business cycles, and so to your point, they're sort of long enough. I hadn't really thought about it that way, but from a psychological standpoint, pretty interesting. I'm a little fearful of potentially this sort of shakedown or this event that seems to be happening where you have like Elizabeth Warren going on this rampage, specifically going on what she's calling non-custodial wallets, this brand new technological innovation she's calling it, of non-custodial wallets. And in the UK, they just passed a bill that they could seize or freeze your crypto accounts without due process. And so the only way they could do that is, again, if you had your Bitcoin on a custodial exchange, right? So it seems like there's this attack vector coming from both Elizabeth Warren and from the UK on custodying your own Bitcoin. And at the same time, you have this ETF narrative. And so it's like, hey, we could buy it on an ETF or maybe keep it in Coinbase, but you can't hold it yourself. So there's that. And then I want to kind of frame this up even more where, we just had the 15th anniversary of the Bitcoin white paper, and Satoshi in the white paper talked about that we no longer require trust. He used the word trust 14 times in the white paper. I think it's like the third most cited word. And we don't need to use these trusted third parties, these trusted intermediaries, right? And so it seems like Bitcoin is made for enemies, or we might say for adversary, right? So